Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, the Genius Act just lit a fire under crypto. Shares of Circle Internet Group CRCL exploded 508% in a month. Bitmine Immersion's ticker BMNR surged nearly 30 times your money in just 5 days after naming Tom Lee as chair. We don't cover Bitcoin and other tokens much here on the channel, but there is something in this, an under-the-radar investment that you cannot ignore. There is one investment that ties the entire era of digital dollars together, and it could be the next to boom. I'm going to show you why Ethereum is about to have its breakout moment, 159% upside and more, along with all the ways to invest, and important updates to Symbiotic and Palantir technologies. But first, if you've ever wondered what's in my portfolio, or just want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. This is the app we've been waiting for, created for investors by investors. I just started using it last year and love the app for getting ideas and sharing my portfolio. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 350,000 investors in the social feed to see what everyone is talking about. Now, I've shared my portfolio on the app and it's totally free to download, so look for the special invite link I'll leave in the description below and check that out. Back to that coming boom though, and how to get your piece of it. Folks, the entire financial system is about to go digital. A new law making its way through Congress is going to give crypto-backed dollars the green light. Every major player from JP Morgan to Amazon is racing to be a part. But forget about chasing the next hot meme stock or token. There is only one guaranteed winner in this coming $2 trillion disruption. It's called Ethereum and it's about to have its breakout moment. That's because Ethereum isn't just part of the system, it is the system. The rails, the infrastructure, and the toll collector to that digital dollar era. I'm going to show you why while stocks like Circle and Bitmine Inversion Technologies fight for the scraps of the table here, Ethereum is set to dominate this trend. First, on the 17th of last month, the Senate passed the Genius Act, which is an acronym that shows you Washington spends half its time just trying to think of witty acronyms for legislation. But beyond that, the bill lays out a framework for regulation and oversight of stablecoins. Now, these are a type of cryptocurrency pegged to the value of the US dollar, using assets like treasuries to keep that token valued at $1 each, and used by traders, investors, and cross-border payments. And that regulation and validation from all this is going to be hugely important as everyone from JP Morgan to Amazon to Walmart look to take advantage of the stablecoins as a digital currency, replacing more expensive transfers like wires and credit cards. It could take the tiny stablecoin market, now just under $250 billion in supply, to a recent McKinsey forecast of $2 trillion by 2030, an 8-fold increase in the market. And even naysayer JP Morgan estimates the supply is going to double to $500 billion over the next 3 years. And now while all this sounds like one of those faraway market ideas like quantum computing or a robot in every home, this massive disruption in the financial sector could start this year. The Genius Act passed by a 68-30 vote with bipartisan support from both Democrats and Republicans, about the only thing the two sides can agree on these days. By comparison, the Genius Act was a virtual kumbaya versus the recent budget bill, which narrowly passed with a 51-50 vote, only by bringing in the vice president as a tiebreaker and losing several Republicans and all Democrats voting no. Now, the House has its own version to work through, but the president has said he wants to sign a finished bill before Washington goes on break in August. Stablecoin is very soon about to become the legitimate and regulated currency. And that's why we've seen shares of Circle Internet Group, ticker CRCL, surge 500% in just the month since its IPO. The company operates the USDC coin with about 25% of the total stablecoin market and a $60 billion in supply. Now, while Tether has a bigger share of the market, as much as 2/3 of it, it's a foreign company and isn't currently in compliance with the regulations proposed in the Genius Act. And the problem is, and always is with these kinds of tech disruptions, while Circle may seem like the dominant player ahead of this trend, it's far from guaranteed that it's going to be the biggest beneficiary. Walmart and Amazon, yes, the largest and second largest retailers in the world with a combined $1.3 trillion in sales, are already talking about issuing their own stablecoins. JP Morgan and most of the major banks are creating their own coins, as well as PayPal and Meta platforms, all of which could crowd out the use of Circle's USDC coin and the return investors are hoping for. But against this uncertainty for who's going to dominate this new stablecoin era, we do know the one investment that's going to benefit. Ethereum is the backbone of the stablecoin market. Think of it like the highway on which stablecoins like USDC and Tether travel. Ethereum is the infrastructure, the digital road that allows stablecoins to move from one person or business to another. More than 27% of Circle's USDC supply and 15% of Tether is on Ethereum, and all the leading Layer 2 systems settle on Ethereum. I know all the crypto jargon can get confusing, but understand Ethereum is stablecoins, and we won't see that 8x growth without it. In still more examples, Robinhood is using Ethereum's Layer 2 network Arbitrum to launch its tokenized US stocks. Deutsche Bank announced its tokenization platform would be built on the network, and BlackRock, the world's largest asset manager, launched its tokenized money market fund on Ethereum last year. With all this, Wall Street and investors are starting to notice. Fundstrat's Tom Lee was appointed chairman of crypto miner Bitmine Immersion Technologies last week, announcing simultaneously that the company would start an Ethereum buying strategy with a $250 million placement, essentially doing what MicroStrategy has done with Bitcoin. That news sent shares of BMNR up almost 3,000% in 5 days as the company becomes a proxy for Ethereum. One of the easiest ways to invest, the way I'm investing, is through the Grayscale Ethereum Mini Trust ETF, ticker ETH, which is designed to follow the value of the crypto through swaps and futures, and has tracked it almost exactly. The reason why I like the ETF instead of buying Ethereum directly on a crypto platform like Coinbase or buying Ethereum futures is with the ETH, I can fine-tune my position with options and get even more leverage or create income. For example, I can sell call options on part of my position, selling 15 contracts worth 1,500 shares at the January 35 strike price. I collected over $3,500 and it's still going to make 46% return if the fund reaches $35 by January. I could also put together a call spread, buying the $25 strike for $4.60 each, and offsetting that by selling the $30 call options for $3.40 for a net cost of just $1.20 per share. If the shares rise to $30 or more by January, the spread is going to be worth $5 a share for a 316% return in just 6 months, and the stock only has to run 23% to do it. Now, if that potential 316% return sounds interesting, but you're not quite sure how to use options investing, look in the description below for a special community discount to our options course. You'll save $150 off the course, get the strategy finder and the options calculator, all with a 14-day free trial, so make sure you check that out. Now, there are other indirect ways to invest in this theme, like with shares of Coinbase, ticker COIN, which is setting itself up to thrive in the stablecoin era. Coinbase co-founded the USDC stablecoin with Circle and earns revenue from interest on reserves as well as transaction fees. You've also got Robinhood Markets, ticker HOOD, could also do well on its crypto wallets and stablecoins trading, along with expanding into on-chain financing, which could set it up as a consumer finance powerhouse. And then there's Fiserv, ticker FI, which I highlighted last week as the financial juggernaut with the old school networks to beat Circle at its own game. Fiserv announced 2 weeks ago a plan to launch its own stablecoin and platform for clients, instantly hooking it up into the 10,000 plus institutions for which process payments and services. Looking at the stocks I'm watching this week, Symbotic Inc., ticker SYM, has surged 75% in the 2 weeks since I recommended it on the channel. It's my top pick for a 20x return. And the shares have moved up to my 4th largest position, up 98% and $133,000 profit. But now I'm starting to see a lot of questions in the comments and the Facebook group asking when to sell, so I wanted to update you on the stock. First though, on this, I have to make a confession myself. Nation, I've had to fight my own decisions to not sell too early on these types of moonshot investments. You see a stock double or triple and it's just too tempting to take that money and run. That's fine for a lot of the quick trade ideas that we talk about, and the stocks you're not sure have that competitive advantage. But for the disruptor technologies like Symbotic, they will make you rich, but you have to give them time. Symbotic is changing the game in the $1.2 trillion market for US warehouse and logistics, and could expand that into the $3.9 trillion global market. Even on a 20% revenue growth this year to $2.2 billion, the company is still tiny compared to that market opportunity and has a lot of room to run. Now, that said, investing is more about your goals than it is about price targets or when some Yahoo in a bow tie says to sell. If this stock has put you above where you need to be to reach your goals with less risk, there is nothing wrong with taking a little risk off the table. Now, that could mean covering some of your downside by selling call options against it or just selling some of your position and taking those profits. Of course, the big news last week was that the Big Beautiful Bill was passed and was signed over the weekend. Not quite so beautiful, but a monster of a budget at 870 pages. Now, there are some winners and losers in the bill that we can talk through, but understand most of this is going to be kind of imperceptible changes at the margins, really only affecting returns by a few percent one way or the other. What is more important, though, is that this shows the government's priorities and how to invest with that as a tailwind behind you, because this won't be the only policy that favors these winners. In the bill, oil and gas stocks get easier access to drill on federal land and lower royalty rates, along with better deductibility of costs, so be watching names like Chevron, CVX, and especially drilling services like Schlumberger, ticker SLB, and Baker Hughes, ticker BKR. Defense was one of the few areas to see an increase in spending, which should make contractors like RTX Corporation, ticker RTX, and Lockheed Martin, LMT, happy. Palantir Technologies, ticker PLTR, is quickly becoming the must-own stock at the intersection of AI and defense, and while it is entirely too expensive for my cheap ass at 107 times price to sales, I am watching for any dips to pick it up. Now, among the biggest losers here is going to be electric vehicles and alternative energy, which sees a lot of the subsidies and tax credits disappearing. I still like Rivian Automotive, ticker RAVN, on its partnership and funding deal with Volkswagen. Think it's going to have its Tesla moment someday, along with Enphase Energy, ticker ENPH, one of the few solar stocks with the financials to survive what's going to be a tough few years for the industry. Showing you the bigger picture here with the Sector Spiders sector tracker. All 11 stock sectors closed higher last week, with the economically sensitive sectors like materials and industrials outperforming after that jobs report beat expectations. Financials also continued to do well after the Fed's stress test cleared the way for banks to increase their dividend payments. Now, what surprised me most last week was strength in material stocks, with all 26 stocks in the sector posting upside returns. The sector includes chemicals, construction materials, metals and mining, and packaging industries, and is one of the most economically sensitive group. That strong jobs report, proof that the economy is holding up, has helped the sector post an 8.6% return so far this year, beating the overall market index. Favorites in the group include Newmont, ticker NEM, and Freeport-McMoRan, ticker FCX, on a bull market in gold and copper, along with CF Industries, ticker CF, for agricultural inputs. Now, updating our market outlook, there's no real earnings or economic data to watch this week. We do see the minutes of the most recent Fed meeting on the 9th, but that surprisingly strong jobs report put the last nail in the coffin for any hope to a rate cut in the Fed's July meeting. The CME FedWatch tool uses interest rate futures pricing to show market expectations for Fed rate cuts, now with a 95% probability that the Fed is going to hold rates when it meets on the 30th. The market is still holding out hope for 2 more rate cuts this year, one in September and one in October or December. That strong jobs report shows the economy is still doing well, so take some of the importance of those rate cuts off the market a little. If the jobs market does hold up, then we don't necessarily need those lower rates like we thought, and stocks can continue to run higher. Now, none of this means it's going to be a straight-up summer for stocks, though, and the next 2 weeks could determine the direction. The president's 90-day pause for tariffs on 75 countries runs out on the 9th, with Trump spooking the market late Friday, saying that tariffs would jump to as high as 70%, with letters to each country going out this week. We've only seen one trade deal with the UK signed, while China and Vietnam have agreed to a framework, but that still leaves a lot of trade that could be tariffed and a return to the April 2nd stock crash. We also have the Consumer Price Index, that CPI measure of inflation, coming next week on July 15th. Despite fears around tariff-induced pricing, inflation hasn't jumped materially yet. May numbers just under 2.4% still showed inflation well above the Fed's 2% target, but prices aren't jumping the 3% plus that people have been warning about. And so that's helped create this Goldilocks scenario where the economy is still growing, inflation has remained pretty much benign, and profits are up, all taking the stock market to new all-time highs. But it has also made investors complacent to the risks. Any increase in inflation could take those few remaining rate cuts off the table and start to hit consumer spending. It would also hit corporate earnings and flow down to jobs as the companies lay off workers in a slowdown. And it looks like that day is coming, according to DataWeave and its survey of 15,000 products in retail. Across the board, prices for clothing and accessories have increased from 2 to 4% from just the beginning of this year. Footwear at Macy's is 4.2% higher, with the upward trend in every department store surveyed. Apparel prices are generally 1 to 2% higher, and handbags are nearly 3% higher at REI. And 2 things you're going to notice looking at this data. First is that increasing trend across the board at every department store and every item. More importantly, though, is that the biggest increases only just started in May, which is why we haven't seen that show up in monthly CPI numbers yet. Now, that could change in this month's report on June prices, and if we do see a surprise jump from the 2.4% pace reported last month, it's going to spook the market. As I pointed out in our Stocks to Watch section, for a long-term investor, there's no need to freak out and start selling. The economy is doing well, and even if we do get a quick summer correction with stocks dipping 3 to 5%, the market should recover by year end. Now, the other argument, though, to this is that investors have made a lot of money over the last few years. Just since the April bottom, some of the most popular stocks on the channel have jumped 40 to 60%, with SoFi up 88% and Symbotic surging 158% in just 3 months. So for those that don't want the risk or the roller coaster that we all know the market can become very quickly, there's nothing wrong with taking a little bit of that risk off the table. That doesn't mean you have to sell out of your favorite stocks though. I can buy a put option on the S&P 500 ETF, the SPY, at the $620 strike price for $4.12 expiring July 18th. That's going to help protect me from the downside over the next 2 weeks from those tariff changes and the inflation data by letting me sell the SPY at $620 if it falls below that price. So if the bottom does drop out of the market, the price on those put options is going to jump and the profit is going to offset some of my losses in other stocks. Even better though, I can offset some of the cost on that, selling the put options at the $610 strike for $2.13 each. Now this lowers my cost to just $1.99 each on a spread that's going to be worth $10 if the ETF drops just 2.5% past that $610 price level over the next 2 weeks. That is a 402% return, but more importantly here is if the market keeps running higher, the upside to your stocks is likely to cover that small loss on your options position. It's a leveraged way to take some of the risk off your portfolio, but still keep that upside if stocks keep running higher. Join me on the Blossom Investing app with the special invite link below and see what 350,000 investors are talking about and what's in my portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.